All right, let's dive back into the markets now with Amanda Agati, PNC's Chief Investment Strategist. Good to see you, Amanda. So, which camp are you in? Those saying that the pullback we've been seeing in the NASDAQ is the beginning of a prolonged pullback, or is this just a healthy correction and a bump in the road?
Well, it's nice to see you as well. Thank you for having me. I'm definitely in the camp that this is not the start of a prolonged pullback in the market. September is historically a very challenging month for stocks. Of course, this September has not disappointed in that regard at all, with the S&P 500 down something like 4.6% for the month, with Q2 earnings season effectively over in the rearview mirror now. Even though it was a better than expected outcome, the market is really fixated on two big macro issues, and that's the election, the race into the election, and the path for COVID. And so with such significant uncertainty swirling around there, it's not all surprising to see the market take a step back here, or at least shop around. It's really kind of the range-bound portion of that square root-shaped market recovery that we've been talking about all year. The market effectively got to a place where it was priced for perfection, when the backdrop is really anything but that. And so we think it's very natural and healthy to see a bit of bumpiness here and even a bit of a pullback as well. But that doesn't mean that the wheels are coming off fundamentals at all.
And are there any relatively safe sectors to invest in ahead of the election?
Well, in a growth-starved world and a yield-starved world, which is effectively where we are finding ourselves, we prefer larger cap names and growthier names, and those that are able to pay dividends, but not high-yielding level dividends. Those are the ones that are still under fairly significant stress. Ones that have the ability to grow dividends, so fortress-like balance sheets, that pay a fairly attractive dividend relative to where interest rates and the 10-year are sitting, with the ability to grow. So large cap growth, mega cap tech. So we're big fans of the Qs, even at current levels. We think that their fundamentals and the sustainability of growth, even mid-COVID where we find ourselves and in a post-COVID world, are just continuing to forge ahead. And so it's a really significant distinction and bifurcated market. We've talked about this when I've been on the show in past appearances, that there's a really significant distinction between the stay-at-home trade and the go-outside trade. And we continue to think, even with the pullback recently, that the stay-at-home trade will continue to be the market leaders.
Amanda, earlier today we had Wells Fargo's Darryl Cronk on, and he believes that the market has priced in a Joe Biden win. Would you agree with that?
I'm not sure that it has necessarily priced it in. I think the market has taken much of this year and gotten comfortable with the idea of Biden being the Democratic nominee, Democratic candidate. I think his choosing of Kamala Harris was the safe pick. So again, I think the market is breathing a sigh of relief there, that we're not really in a scenario where we have two very, very polarizing candidates at the opposite ends of the spectrum. If we had a further left candidate in the Democratic nominee seat, I think the market would be struggling with that. So I'm not sure that the market has effectively priced it in per se, but it's not anywhere near the extreme risk that we were concerned about at the start of 2020. I think the market is still wrestling with the concern about the rising probability of a Democratic sweep, which was not really in the cards at the beginning of the year, but we're seeing a rising probability of that as well. I think that will definitely cause the market some challenges as we move into the end of the year if it were to occur.
Hi, Amanda. Just wanted to ask you about some weekly flows data that we got. We still got some money pouring into investment grade bonds, corporate bonds, but not as much as we've seen. Also some outflows from gold, and just in general, it looks like there's a lot of money moving into emerging markets, likely predicated on a lower U.S. dollar. What's your view of the EM space or any of these other markets I just mentioned?
Well, we actually believe that emerging markets is one of the most attractive equity asset classes out there right now. The fundamental backdrop for emerging markets continues to be very, very strong. The earnings growth trajectory is stronger than anywhere else in the developed world, and certainly relative to the US. They have not fallen as far this year as US equity asset classes have, nor for developed international. And there's a really significant snapback projected for 2021. So we think the backdrop there for emerging markets is very attractive. They were the first to enter and address the COVID situation, first to exit, of course, and we're seeing a very manageable second wave there. And they've been able to handle it quite well. And so we don't see that as the significant risk that the US is still facing, as well as parts of Western Europe. And then when you look at it from a valuation basis, very, very attractive relative to the other equity asset classes. So we would definitely be buyers of emerging markets here at current levels.
Amanda, let me paint this scenario. Let's say we get a COVID vaccine in the first half of 2021 and a President Joe Biden gets those higher taxes he's been clamoring for. What happens to stocks 12 months after?
Well, that's a good question. I think at the end of the day, the path forward should be governed by the path of earnings growth. And so it's really going to be interesting to see what happens with that. The next 12 months earnings growth projection is only about 1%. So even where we're sitting today, forget about those two events for a moment. That's not much of a catalyst to keep this market rally going. To the extent that we do get a vaccine and we get broad-based distribution and we also get broad-based uptake, that is, the public is willing to take it broadly, that we could see some upside to earnings projections. But it's hard to see it hitting in the first half. So it could very well be setting the stage for kind of a Hail Mary second half 2021 in terms of really rallying earnings growth. The Biden tax story is a big headwind potentially. Our base case is not that tax hikes will go into effect in early 2021, but based on our back of the envelope math, it could be as much as an 11 to 12% earnings growth hit next year if it did go into effect early. So huge headwind when we have next to no earnings growth projected over the next 12 months. It's hitting at a very inopportune time. The offset to that is the possibility that he might roll back China-related tariffs. And so that may add back 5 or 6% or so to earnings growth. Net, it's still a negative. There's no scenario where tax increases are a positive for the trajectory forward for the market. So it's something we'll continue to watch pretty closely. But I think in sort of a weird kind of paradoxical way, the virus actually, in our view, will slow down a lot of the grand and sweeping policy changes coming out of a potentially new administration. So pick your poison a little bit. It's not that we, really are feeling good about where we are from a pandemic and COVID specific standpoint, but I do think that will continue to be the primary focus, regardless of whoever wins the election. And so everything else may take a backseat relative to dealing with that.
Amanda Agati, PNC's Chief Investment Strategist. Good to see you and enjoy your weekend.
Thank you. You too.